Hi, student. Good day. Today, our study topic is Chapter 10, ACCA F7, Kaplan study text we are following. Chapter 10 is relating to the revenue, which we straight away we are starting now. So, this is a very important chapter because this is the base for a account student to just to know, to understand, and to identify how the revenue is recognized in the books of accounts. So revenue is a simple definition when risk and reward is the transfer. So you can recognize, but now according to the standard, according to IFRS and ACCA instructions, guidelines, so these rules we need to follow. So upon completion of this chapter, we will understand identification process of contracts, identification performance obligation, determination of transaction price, allocation of price performance obligations, and recognition of revenue when its performance obligation is satisfied. So these elements, when we satisfy all these requirements, so we will recognize the revenue in our books of accounts. So then it says explain the and apply the criteria, recognize revenue generated from contracts. Here there mean to say contract about the construction contracts or any sale and purchase agreement or any binding agreements are there, or any contractual agreements are there where something or some performance related obligations are linked or attached with the agreement. So when it fulfill, so that according to terms and condition, then only it will recognize the revenue at the point of time. So describe the acceptable method of measuring progress toward complete satisfaction of performance obligation. Explain and apply the criteria of recognition context to the cost. Then apply the principle of recognition revenue, principal versus agent, repurchase agreement, bill and hold arrangements, consignment arrangements. All these points we will discuss now in this chapter, but we will have to run fast. So, but my always attention to explain the concept with the practical example from the market, from the industry norms. So it make it easy for a student to understand. So IFRS 15 is a point to remember is for revenue from contracts with the customers. The five-step approach recognition criteria is there. So you just need to remember this five-step approach. Once you understand this approach, you are done with this chapter and you are done with the revenue recognition criteria. So it will help you in strategic business reporting, also SBR paper, and even in auditing paper, because these all are linked with each other. Recognize revenue, apply the following steps, five-step formula. Identify the contract, identify the separate performance obligation with the contract, determine the transaction price, allocate the transaction price to the performance obligation in the contract, recognize revenue when a performance obligation is recognized. Now five-step formula will be there. You just you can read through this paragraph also. In under this illustration, it will clear you the concept. So wait receives an order from customer for a computer as well as the 12 months of technical support. We deliver the computer and transfer its legal title, mean issue the invoice and all documentation process complete, and the customer on the same day. Okay, so risk and reward transfer on the same day. Customer paid 420 on December 1. The computer normally sells for 300 and technical support for 120. Technical support for 1 year is 120 and 300 is the price of the sale. Now see the how five-step formula will applicable there. Identify the contract. There is an agreement between Wade and its customer for the provision of goods, the computer and services and technical support. This thing is satisfied and complete. Step 2, identify the separate performance obligation within the contract. Two part was there for obligation of the contract: supply of a computer and supply of technical support. Absolutely. And then determine the transaction price. Total transaction price was determined at $420. Step 4, allocate the transaction price of the performance based on stated standalone sales price. 300 should be allocated to the sales of computer and 120 should be allocated to the sale of technical support. Okay. So this is the part of the explanation how it is they determine over the time. Recognize revenue when performance obligation is satisfied. Control over computer has been passed. Risk and reward passed. Goods and revenue should be recognized in the books of account. This is on this date. It will be recognized. And technical support. Well, revenue from this should be recognized over time in the year end 31st December. Revenue is $10 for 112 or 120. $10 should be recognized from the provision of technical support. Every month they will recognize the $10 to which will be a $120 by the end of year. Now 5-year recognition is now it is in more detail it is explained. I will scroll down and you can go through this reading part of this book. As for IFRS 15, it is explained. Contract can be agreed in writing orally through the other customer business parties. An entity can only be account for revenue if contract meets the following criteria. The parties of contract have approved contract and committed to perform. Entity can identify each party rights regarding the goods. Entity can identify the payment terms. Contract has a commercial substance. It is probable that entity will collect the consideration to which it will be entitled in exchange of the goods or services that will be transferred to the customer. So this rule should be followed. Again, there is a illustration. Mono company has year ended 31st December March 2006. On January, Mono company signed a contract with the customer to supply them with the asset 31st March 2006 in return of payment of 360,000 on September. The control of the asset passed to the customer on 31st March. Okay, by 31st March, the result of change in the economic climate, Mono company did not believe that it would probably be paid 360,000. Therefore, contract cannot be accounted for and no revenue should be recognized. So this is method will be there. You have to understand the base of the logic of this contract, how it is made and according to their intention to fulfill the obligation. Identify and separate performance obligation within the contract. Performance obligation are promises to transfer distinct goods or services to customer. So this go to this paragraph. It will explain you the scenario in more detail. So this is illustration of agency sales, how it is done. This is easy example, just go through. Step 3, determining the transaction price. So what is the transaction price again for this their agreement? When determining the transaction price, an entity shall consider the effect of the following: variable consideration, the existence of significant financing component, non-cash consideration, and consideration payable to customer. So these points should be taken into consideration. Variable consideration. Variable consideration is the receivable within the contract can vary because of such things as rebate, rebate, incentive, performance bonuses, or other similar item as was sold, the right of return or fixed amount is promised as performance bonus is certain condition are achieved, such as timely completion of construction. So these variable consideration should be taken into consideration. So these are varies according to the uh, fulfillment of their commitment. The financing part, in determining the transaction price, entity must consider if the timing of payment provides the customer entity with the significant financing benefit. So these things also taken into consideration. The difference between amount of promised consideration and cash sales price, significant length of time between the transfer of promised goods or services to the customer and payment date. So these are the test your understanding. You can go through and while scrolling down, when I if at the end of chapter, I will show you their answers, so you can do it at your own in your free time, because we will do it in our revision classes for the regular students who are our who taking revision as well. So during our for the paid student, and we provide them a complete study text revision kit pass card of the Kaplan for the for this period, and we provide them all WhatsApp support and online support as well. Okay, consideration payable to customer. If consideration is paid to a customer in exchange for a distinct goods or services, then it is essentially a purchase transaction. So these are also there. See, under this illustration, consideration payable to customers. Consideration for the buy at least 20 million of product over the next 12 months. The term of the contract require Golden Gate Company to make a payment of sterling 1 million to compensate the customer to changes that will need to make its retail store accommodate in the products. So this is for consideration for the fulfillment of obligation. So these things are also well explained over here. The payment made to customer is not an exchange for the distinct goods or services. Therefore, the 1 million paid to the customer is a reduction of the transaction price. The total transaction price is being. This is the way how they have explained the whole scenario. This is easy to understand, so you will these are the basic things which are communicated at the time of agreement. Step 4, allocate the transaction price. So whatever transaction is involved, transaction price or discounts or whatever you are giving a rebate to them, so it should be taken into consideration. Step 5 is a recognize the revenue. Revenue recognized when the entity satisfy a performance obligation by transferring promised goods or services to customer. This is the definition. So these key points you remember for the exam point of view. Satisfying a performance obligation at a point of time. Following are indicator of transfer of control. The entity has a present right to payment for the asset. Customer has a legal title of asset. Entity has a transfer physical possession, risk and reward transfer. Customer has a significant risk and reward ownership of the asset. Customer has accepted the asset. So these are easy points you consider yourself when you make any agreement, you buy any product or item from the day-to-day use, or any equipment you buy. So you always you follow these steps, and obviously all the steps in routine we are doing, but when you are going through this revenue recognition point of view, it is well explained. Consignment inventory. Consignment inventories are those which are delivered by the producer on the sale basis. Whenever they get it sold, so they get the payment. So this can be arise in the issue of consignment inventory, where one party legally owns the inventory, but another party keeps it inventory on the its premises. The key issue of relate which party has the majority of indicator. The main example of car sellers. So in car showrooms, so some many cars are owned by the owner, other owners, and this showroom just keep them as a inventory of on behalf of other customer, but they don't own this one. So these examples are more in detail. Consignment inventory example, you can read this Ford Motor Company car manufacturer, this example. This is well explained and is easier. You can see this solution as well, how they identify, how they have explained all this scenario. Repurchase agreement. So repurchase agreement is the agreement is where an entity sell an asset and promises or has a right to repurchase the asset. This is not recognized as a sale, but either as a lease or secured loan against assets. So this definition you have to remember. It is tested oftenly in the examination. Obligation to repurchase, right to repurchase, or obligation to repurchase, customer request is there. So this is the reading part. Just go through. This is important. Sale and repurchase. Again, this is relating to the leasing. Sale and repurchase are hire purchase agreements. So this example is also very easier one. Anything you need feedback, you can comment in the video or get back to me through WhatsApp support. So we'll provide you support as well. Bill and hold arrangements. So what is a bill and hold arrangement? Is a contract under which entity bills bills a customer for a product, but the entity retains physical possession of the product until it's transferred to customer at a point of time in the future. But this is to be recognized when revenue customer must have obtained control of the product despite its physical remaining with the entity. There may be a fee of custodial service charges are there, so you just go through. This is a easy bit. Substance over form. Substance over form means a common feature of a transaction whose substance is not readily apparent, or legal title to an asset may be separated from principal benefit and risk associated with the asset. As with the lease, transaction may be linked with the other transaction when means that commercial effect of individual transaction. Option may be include a transaction where the terms of the option make it highly likely that the option will be exercised. This is example, test your understanding is going on. So you just go through. Satisfying a performance obligation over time. Entity transfer control of a goods or services over time and therefore satisfy performance obligation and recognize revenue over a time if one of the following criteria is met: the customer simultaneously receive and consumes the benefit provided by the entity performance as the entity performs. Entities performance creates or enhance an asset, for example work in progress that the customer control as an asset is created or enhanced, or the entity's performance does not create an asset with the alternative. Contract cost is there. Key points: asset should be recognized for the incremental cost of obtaining a contract. Revenue recognition, again they have mentioned a key points. Actually, student, we are going through this whole chapter, so all area, whatever they have, Kaplan has highlighted. We just going through, just to give you a double edge. One is the explanation from my side, and the book knowledge is available for you to just to review and have a knowledge on this. If it goes scroll down little bit faster, you can pause it and you can read through. This is a illustration for a construction contract. Now it is presented in the financial statement. Determination of progress of contract. Statement of profit and loss. These are the steps which you need to follow in your books in at the time of answering in your paper. You will find the answer solution. I'll give you at the next slides at the end of this chapter 10. This is chapter summary for revenue from the contracts IS 15. IFRS 15, identify the contract, identify the separate performance obligations. The basic is a 5-step rule. Determine the transaction price, allocate the price, and recognize the revenue. That's all for this chapter. Wish you all the best, students, and you can see the test your understanding answers as well. But those students who are interested to join our paid sessions, they can join us by joining for $25 is our fee, where they will have our support for 90 days. Like one exam session, we will provide a support, and then this one they will get a revision classes, live revision through the live revision kit for the same Kaplan book. We provide study text, Kaplan book, and pass cards in $25 for 90 days. We give live revision classes as well, not a recorded one. So you can get back to us, contact me, and WhatsApp me your inquiry. You can WhatsApp. For all student support will be provided. Okay, student, this is now concluding. So wish you all the best. And if you have any question, get back to me.